Welcome back to Fast Market on the TD Ameritrade Network. Let's bring in our next guest for our cash tag segment. That's going to be Andy Swan, co-founder of LikeFolio. Welcome back to the show, Andy.
Hey, thank you for having me.
All right, it's been a tumultuous couple days for markets here and for investors and traders alike, especially in the financial sector. What kind of data are you guys seeing out of LikeFolio? I'm sure it's just been massive recently.
Yeah, it really has. You know, one of the things we can look at in these situations because of our unique ability to look into social media mentions across the internet and all of that user-generated content is where consumers and investors are really focusing their attention. And from the kind of consumer side of things, the everyman kind of side of things, is where are people talking about withdrawing their money from their bank? And we see a huge spike in people talking about withdrawing money from their bank. In fact, it's over 4 times as large as we saw all of 2022. A massive spike occurred this weekend. This is people talking about, I'm going to get some money out of the bank. I'm going to the ATM to get some money out. I'm going to spread money out across multiple accounts. There's a real shift happening in the consumer banking mindset in terms of an awareness of exactly what these FDIC rules are, even though they seem to be changing overnight as it may benefit those politically connected right now. But people are starting to figure out, what works, what doesn't. I've got to get my money out. A lot of movement into Bitcoin. As a result, we see Bitcoin up significantly in both price and the level of attention that people are giving it. And then when we look at the investor side of things, we look, where are investors most concerned? Which banks are investors most concerned about? And to do that, we look at the number of people talking about each ticker symbol, how that compares to normal. And you can see, when we chart that out, SVB, the Silicon Valley Bank obviously was the first domino to fall. People identified that very, very quickly. Now that stock's zero. Signature Bank of New York, down again, went down last night. FDIC took that over. Again, that stock went to zero. That was the second one that investors saw. Now for third and fourth, these haven't been put into receivership by the FDIC. I don't know that they will. But if they follow the pattern of the first two, this is where investors have turned their attention, and that's First Republic Bank, which is down an extraordinary amount today, and Key Corp, which is down again an extraordinary amount, nearly 2/3 from where it was last week. So, from a general public banking sentiment kind of perspective, I think people are getting very concerned about, is their money safe and how do they access it? And from an investor perspective, we've really seen the masses do a very, very good job of identifying which companies and which banks are most susceptible to being zeroed out.
Andy, does your data show, because what it appears to me and what appears the future, at least short term might be, is a move from small banks to big banks, because the data has come out to saying the big banks are 3 times more capitalized than they were in 2008. So are you seeing any movement like, I'm getting out of this bank, I'm going to this bank? We're seeing a lot of movement towards JP Morgan, towards Bank of America, towards the larger cap banks. Is your data showing that at all?
Yeah, that's absolutely the sentiment people have. There's kind of, there's this thing, I'm going to get some money out of the bank, or for a certain set of the population, they may have more than what the FDIC insurance is, and they're trying to figure out how to spread that out. So there's 2 things you can do with it. Well, there's 3. You can put some cash underneath your mattress, which is, obviously some people do that. But then you're stuck. If you're not going to do that, where do you put it next? Where is the safe place to put it? Well, the banks that received bailouts before, the large banks, are probably your best bet. Consumers and investors have both figured out that's a good spot. And then the other spot that we're seeing people flee to is Bitcoin, as that decentralized, just take me out of this entire game kind of play. And you can see that in the Bitcoin price action and the attention that cryptocurrencies are getting over the last 3 days.
Yeah, and Andy, when you look at some of this data, the banking withdrawal mentions just astronomical. I get that part of it, but overall, the banking sector, as Kevin mentioned, it's better than it was in 2008, 2009. It's improved that way, but you mentioned Bitcoin. We've got the chart up there, up over 20%. We've got flows into gold up nearly 2.5% today. So safety plays here as people pushing treasuries too. But is this just one of those hiccups where it's just that the consumer, and maybe your data will reflect that this is an outsized move, it needs some time, but then we'll get back to those levels where people are comfortable, and maybe the FDIC raises that $250,000 cap, where people get more comfortable, where we get the shock, we get more regulation, and then you'll see your data fall relatively quickly?
Yeah, I think that's right. Most of the time when there's a shock to the system, it's kind of short-lived in terms of the amount of attention that it gets. I think it really depends on if there's more failures by more banks. As far as the FDIC insurance goes, I think there's this kind of dual path here. You can kind of say, okay, it's good that they're insuring this. It's good, you can make the argument it's good that they're backing up deposits beyond that limit, but it kind of makes you wonder why the limit was there in the first place, and do I even need to pay attention to the limit if every time there's a shock to the system, the powers that be will go out of their way to make sure that everybody's covered no matter what. So I think, as we move forward, I think it's going to be really interesting to try to understand the rationale and the process behind these decisions that people in charge are making, because it seems like we've completely flipped the script from Powell being and the Federal Reserve being in charge of how the market reacts to now market reactions determining how the Federal Reserve will react in the future. And I think at this point, the idea that the Federal Reserve is going to go out and raise rates in a big way in March or April is kind of out the window. And in fact, I think several banks are even calling for rate cuts at this point. So that shows you how quickly things can change when ultimately the market decides the fate rather than a few Fed governors.
Yeah, the market figures out where there's cracks in maybe the system at that point. But great data as always, Andy. Appreciate it. Have a good day.
Thanks, you too.
All right, that's Andy Swan, co-founder of LikeFolio, breaking down some of the data that they have on the run-on banks and